Welcome to the Point Podcast. I'm your host, Rinn, and my guest is Phil Atwin. You guys are in for a real treat. I have known Phil for over 30 years. He is recognized as one of the most sought after speakers when it comes to 1031 exchanges. Phil is the Senior Vice President and one of the founders of Exchange Resources, Inc. Now, Phil began his career in 1982 in marketing and sales with a large title insurance company. In 1998, Phil transitioned and focused on 1031 exchanges with his current company. Now, Phil conducts at least 120 to 150 educational seminars per year to a wide variety of groups, financial planners, CPAs, the tax groups, the bar association, and certainly title insurance companies and real estate firms. Now, Phil grew up in Pasadena, California, and now lives in Whittier, where he and his wife enjoy their children and 5 grandchildren. Phil, the real estate market, with everything else, is changing very, very rapidly. Educate us. Tell us about the 1031 exchanges. What changes are happening in the industry? How many of because as you know, many of our listeners will be realtors, and they certainly would like to be updated with the latest trends. So how can you and I help our clients to be able to buy more real estate, use your services more often, and so forth? So it's really strange because it's only about 10% or less than 10% in the United States have more than one property. About 50% have a home, but they don't have another property for an investment, which I think is tragic because investment is the fastest and perhaps the safest way for wealth creation. So Phil will explain to us what to do and how to do it. So, Phil, let's start with what is a 1031 exchange?
It's a good question. And hello to all your viewers today, Louis. Thank you for having me here. Yes, we have known each other for a long time, and it's been a pleasure. A 1031 exchange was something that Congress enacted 100 years ago back in August. We just had our 100th anniversary, and I don't even look a day over, 67? Right. So the bottom line is that our industry has been around for just over 100 years now. It was created by Congress for the purpose of not tax-free, but deferring capital gains taxes when you sell a piece of property that is rental, investment, or business use. And they will allow you to take your tax base with you, not property tax base, but your IRS tax base with you into the acquisition of replacement property of equal or greater value. When you do that, it allows you to use all the money you would normally have to pay in taxes for the purpose of releveraging the equity into better properties, more front doors that will generate rent for you, whether it be residential or commercial, for the purpose of having more properties that will appreciate over time as inflation does its thing to the value of properties, and ultimately to create additional tax write-offs. Why is that such a big deal? Why would the IRS and why would the federal government and ultimately the Treasury Department allow you to defer tax? The answer is actually multifold. The first reason is because it puts a lot of people to work every time they sell properties. Because when you sell properties, you have to hire a real estate person. You have to hire an escrow person. You have to hire a 1031 exchange facilitator. You pay transfer taxes, recording fees. You pay people who are inspectors and appraisers, people who will fix things. The exchange will touch between 40 and 60 people in terms of the transaction of sale. Then it will do it again when you go to buy. Every time you employ those people, guess what happens? They all make an income, which means they all pay ordinary income tax to the federal government and the government and the state government. And then they go out and spend the money that they just earned, which in turn allow other people in other areas to be touched with new business who will also pay taxes and spend money. So the Treasury Department had a really innovative, or better yet, the Congress had a very innovative idea of creating this exchange, and it allows the investor to produce more housing or more commercial or industrial buildings for themselves to create income with, which means they will also pay taxes on that income and then go out and spend money. So it just continues to create a churning of money so that the government makes more money in terms of taxes in other ways. So, and it keeps the economy humming. That's when it was created in 1921. And ultimately, here we are, 2021 now, and it's going strong. It's got some challenges coming up right now in the government, of which I'll be happy to share with you in a couple of minutes. But the bottom line is, it helps investors to create additional wealth. The question is why? Most people don't realize it. Some do. The higher the equity is in a building, the lower the rate of return on that equity is. So what they do is they leverage the equity by buying more and additional properties. You can do that by either borrowing money out and going out and acquire, or sell the property and do this thing called the 1031 exchange to create a higher rate of return when you consider income, when you consider expenses, and how much equity is in the building. Your rate of return actually goes up because the equity is working harder for you. Think about it. If you had two properties, identical properties on the same street that were purchased for the same price and the same floor plan, I mean, everything's the same. One is paid off, the other one is not. The one that is not actually makes a higher rate of return because it has less equity in it. Do you know what that means? The one with all the equity in it can't charge any more in terms of rent because rent is not predicated on equity. It's predicated on fair market value for the same identical property. Number two, when inflation hits and values of properties go up, guess what happens? The one that has less equity has a better rate of return on the increase because there's more equity in the paid off property. Thirdly, you have additional tax write-offs. So this exchange stimulates your portfolio to work harder for you so you don't have to. Eventually, when you go to retire, and if this is going to become your sole or primary source of income, paying off the properties makes sense at that time because the less debt you have, the more of the income you get to keep. But the rate of return is actually higher on the equity and in the lower equity property than it is in the higher equity property because it can't charge more rent. It just can't. And that's the beauty of the 1031 exchange.
Yeah, I have heard explaining by Doug Andrews in maybe 2006, very similar as you do. I don't know if you heard Doug Andrews. He wrote The Misfortune and so forth. He was very popular at the time, but I think a lot of people misused his advice. You mentioned that when people are exchanging a property, they need a facilitator. What is the purpose to have a facilitator?
It's just the government's bureaucratic way of saying, if you want to do this, this is how you do it. And ultimately what's happened is an exchange, if you think about it, is a trade. Now, when the exchange was created in 1921 by Congress, you're talking about the swapping of properties, of which you did not need a facilitator because basically it was a direct trade. Well, when a man by the name of Mr. Starker went to sue both the federal government in the area of the Internal Revenue Service and the U.S. Treasury Department, he did this because they denied him to exchange and he wanted to buy over time. He did not want to close immediately and do a direct trade. Long story short, what happened was, as a result of that lawsuit, which, by the way, litigated for 20 years, the bottom line is that a judge said, you're right, you can buy other property. And that created this facilitator that the IRS had to put in. So it continued to be a trade through the facilitator. So you're actually trading not deed title anymore or fee title, but through contract, that it's the facilitator who's going to be trading with you. You sell the property through the facilitator, you acquire the property through the facilitator. Back in the old days, we had to do something called sequential deeding. Sequential deeding means the seller would deed the property to us, and then we would deed the property to the buyer. And then when they go to buy, the seller would deed the property to us, and then we would give them that property as a replacement. You don't have to go through that anymore. The government realized that the facilitator does not need to be on title, just via contract. So that's why you have to have a facilitator when you're doing a 1031 tax deferred exchange of any kind.
So what are the charges for it to be, I suppose it goes on the exchange values and so forth.
Right.
How do you arrive to the charges?
It depends on the kind of exchanges there are, because there's several kinds of exchanges. There's concurrent closings. There's delayed closing, where you close the sale first and then the purchase up to 180 days later. That general fee under $2 million of sale is $950. It's pretty low.
Very reasonable.
Yeah, very. And if it's a sale of $2 million or above, then the fee jumps way up from $950 to $1,250. So it's only $300 more. If you're going to do a reverse exchange, the government allows you to close an acquisition first through the accommodator in a 1031 exchange, and then close the sale up to 180 days later. That begins at $8,000 because of all the paperwork and the holding corporation that the federal government's going to make us do to comply to the rules of this closing a purchase first and a sale second. So that begins at $8,000. There's something called a build-to-suit exchange. A build-to-suit exchange is when you sell a property, buy a little lower, we take title to the property, and then you build the improvements to get you back up to an equal or greater amount with the proceeds that came out of the sale. That starts at $8,000, $8,500. Not very many exchange companies do that. Some do, and the bottom line is that those are more expensive as well. And there's hybrid exchanges where, for example, if you're selling 3 properties and you could close the first 2 in time to go into the acquisition, but you couldn't get the third one to close in time, what we would do is a hybrid exchange, a delayed exchange for the first 2 sales that goes into the purchase. And for that, a portion of that same purchase, we will do a reverse exchange where you're closing the purchase first, and then in this case, the last sale afterwards up to 180 days later. That also will begin somewhere around $9,000 and going up. So the bottom line is, for a typical delayed exchange, you're looking at $950, and then it goes up from there depending on what you were trying to accomplish. But that's kind of a feel for the fees.
Sure. Now, Phil, you mentioned a couple of times 180 days, and I was a number of years ago, I was nearly almost a commercial broker, so I understand the 181. But can you explain to our realtors and friends or whoever is watching this podcast the importance of the 180 days?
180 days, first of all, Louis, that's a good question. So many people say, well, it's 6 months.
6 months, that's
180 days is not 6 months.
Right.
180 days is 2 days less this year.
Mm-hmm.
When there's leap year, it's even longer.
Right.
So 180 days means 180 days. But the big question is, when does this period begin? And the answer is at the close of the sale. So once the sale closes on a delayed exchange, you have 180 days to take title to your new replacement property or properties, because you can go and diversify and go into multiple properties. So the 180 days is significant. Remember, we as the accommodator have to set up the exchange through the escrow officer, or if you're watching in an attorney state, with your attorney who handles the escrow before escrow closes.
Right.
Once we get all the documents set up, then the closing happens. So if it closes today, Friday, and today's the 15th, that means tomorrow, Saturday, is day one of 180 days.
Yeah. Now, do you see any changes coming with a new administration regarding the 1031 exchanges, or you think everything is going to stay the same, or what changes do you see? Once again, how can we educate those people who are interested in 1031 exchanges?
Yeah, Louis, the following information I'm going to share with you and your audience is not a perspective on Democrat or Republican. There's nothing political I'm going to share with you.
Right.
But it's going to be the facts of what is happening right now. Back in late April of this year, the White House came up with a tax package. The definition or the name of this tax package was called the American Families Plan. Name sounds pretty good. It's here to help American families. But it greatly affects this exchange process and the paying of taxes and some other issues with real estate. And since you asked me, I'd like to bring these up right now.
Please do.
Number one, the administration wanted to completely eliminate the 1031 exchange. They felt that it was nothing but a tax-free write-off to the rich. Well, that's foolish, because how many of you are not rich? And the bottom line is, you've bought property, you were smart enough to make the sacrifice to put your hard-earned money into a property that could help pay you income and then help you retire once you go to retire, because the government's not going to pay you enough money. You're not here to live off the government. You're here to take care of yourself. So the first thing that happened was you wanted to eliminate it. Then second, with all the backlash that they've got, they said, okay, we're not going to eliminate it, but we're going to reduce the benefit. So the gain will not be over $500,000. And anything above that, you'll have to pay all those taxes on. So that's still in jeopardy, because that bill that was adjusted was sent to Congress back on April the 28th. As of today, and today's the 15th of October, that bill hasn't been voted on. There's a lot of dissension right now by both Democrats and Republicans. So it's just sitting there floundering. Now, that's the bad news. The good news is the Congress in the House Ways and Means Committee, that's the committee that kind of helps dictate and encapsulize what they recommend that the higher House of Representatives vote for, have decided to eliminate any language to change the 1031 exchange. So that was good. It was a good recommendation by them. And the bottom line is we're going to wait to see what is going to happen in terms of the vote. The second thing that came up in the American Families Plan, amongst other things, was the ability for the government to change the 15 to 20%, the 20% capital gain hike, the cap, I should say, to almost 40%, to 39.6%. That means when you sell your principal residence or a second home or vacation home or a rental property, with the income and the gain that the property would generate, it would go into your ordinary income tax and raise that bracket to 39.6%. And the bottom line is that you're going to pay a horrific amount of taxes on that.
Especially in California.
Yeah, California or any state where values are just exceedingly going up and accelerating because of Californians and New Yorkers and other people fleeing the states because some of the other states are just so much better value and a better rate of return for them. And less government bureaucracy. You cannot believe how many phone calls I get. Like today, I got a lady who owns property, lots of properties here in the US, and she was up in Toronto, and she's saying, I can't get rid of my tenants in there. They claim that they can't pay their rent because of COVID, yet they post on their Facebook, they're traveling to Europe, they're going to South America, they're going here and doing this and spending money, but they can't pay the rent. Well, I just find that, and there's a lot of people who are struggling, that the government is protecting the tenants far more, whether it be state or federal, than it is the landlords, the property owners, the people who made the investment to provide housing.
Yeah.
The second thing that they want to do is not just raise that tax to 39.6%, they want to eliminate the stepped up basis. Louis, when somebody has a piece of property and it grows over time, whether they exchange or not exchange, doesn't matter if they're principal residence, second home, vacation home, rental property, whatever. In 1954, the federal government put into law something called the stepped up basis. That gives the opportunity through a trust or other type of vehicles that when you pass away, your heirs not only lose you, but they gain your property, and they gained your basis. So if there's $1 million gain in the property, you would have the hardship of having to deal with that gain.
Right.
In 1954, the government says they'll get a stepped up basis, which means the property value, maybe I bought it for $36,000 back then, it's now worth $1 million. Well, the heirs will inherit it at the $1 million value, the value at the date of passing. The American Families Plan wanted to totally eliminate the
But then they
stepped-up
would have
basis.
to pay taxes on it.
What happens if the elderly people have been utilizing it in a reverse mortgage or have been refinancing to take cash out? So the heirs may not inherit as much equity as they would gain. So the question is, how would they even pay off and get rid of the property to pay the taxes if they can't even cover it with the amount of equity that's in the building?
Amazing.
That is a problem. That's going to cause a lot of hardship. And then thirdly, the stepped-up basis, the eliminating the 1031 exchange, and then ultimately, the raising of taxes is what's inside of this plan. Well, the Congress and the House Ways and Means Committee said we're going to eliminate any language about getting rid of the stepped-up basis because that's going to cripple the economy. The second thing is getting rid of the exchange language in there. We're going to take that out totally, and the exchange won't be changed either. We'll leave it that way because that's going to cripple the economy. And then we're going to change the 39.6% recommendation from the White House to, instead of 20% as a cap, between 25 and 27%, which is still a huge increase.
Right.
But at least it's not the doubling of the tax. So that's the history of what's happening right now. So Louis, people ask me, what's going to happen next? We're waiting for Congress to make a move.
Yeah.
They're afraid to, and they're divided. I don't mean Republicans to Democrats. I mean Democrats to Democrats.
Yeah,
and some Republicans to Republicans. So we'll have to wait and see when they're going to vote on this and how they're going to vote. And then it's got to go to the Senate. And then once the Senate decides, it becomes law.
Basically, this was my next question, that what advice would you give to some of the real estate investors, whether they brand new, they want to start out with a single family home, or larger investors? What advice would you give them regarding the new, perhaps the tax also that the 1031 exchanges?
Yeah, investors buy real estate. People who own homes will buy other real estate other than their home for three main reasons. Number one, income. You want the property to generate income for you on a monthly basis. And the more front doors you have, the more often you get paid each month. So if you want to get paid at one time a month, you have a condo or a single family or a single unit commercial or industrial building. If you want to get paid once a week, you have 4 front doors because you're going to get a check 4 times a month, one for each building. If you want to get paid every day, you own 30 front doors. You just told me a very interesting story before we went online with this about the number of units one of the person that you met at this conference has. The bottom line is the more doors you have, the more income you make. And guess what happens over time? Rent tends to go up. So, number 2, you want the ability to watch the asset grow in value, not just produce income, but to grow equity. And number 3, the beauty of owning investment property is to be able to depreciate it. There are limitations to how much property taxes you can write off your federal return now. There's the limitation on how much interest you can take for write-off. That doesn't apply to your investment rentals because it's business use, and you're allowed to utilize 100% of the write-off, which means you get to keep more of the rent that the property generates because of the write-offs through depreciation, through interest deductions, property tax deductions, and other items. So the bottom line is buy investment property. If you don't have anything, buy at least 1 or 2 pieces of property. Why? Because the people who I know who are the most financially secure own a big part of their portfolio is in real estate, not just the stock market. because the stock market can waver up and down, and so does property. But the difference between the stock market and real estate, when the stock market goes down, you've lost everything.
You know, it's interesting what you're saying, because I don't know if you know it. Now I'm working with Marcon Mortgage as a real estate wealth advisor. And basically we're teaching to realtors and to the public or whoever I can talk to that the real estate has 5 economic benefits, right? Now, if you buy stocks, you have only one benefit, that stock, right? And it's a linear income. And with the 5 benefits, basically you can create wealth without saving money, right? And
it's amazing.
And I'm 100% convinced, or no, you know, I've been in that business maybe longer than you.
Well, maybe the same.
Yeah, we're the same. But that the real estate is really the safest and best way or path to retirement or income, because let's face it, more than 55% of the people have less than $40,000 saving in the United States. 80%, and these are not my teaching, as you can look at the different reports, even publications. 80% of the people living from paycheck to paycheck. Why do you go to Walmart and see the elderly standing at the door or helping here or helping there? Because people just don't save enough in the United States, which is tragic. But in my opinion, and I know that you agree with it, the best.
You're a man in demand.
No, the best way to create wealth is to buy a property beside your home and have the tenant pay it off.
The best way to create financial independence is to own investment real estate.
Yes.
Let me give you a tale of 2 uncles that I have. They're completely different. One is my wife's uncle. All he buys is commercial and industrial buildings. He will not touch a residential building with a 10-foot pole. He's a multi-millionaire. There's another uncle that I have. He will only buy single-family homes, never units, never commercial or industrial. He's very, very wealthy, multi-millionaire. Which one was right? The answer is
Both.
We both are. What matters is that you acquire property that'll work for you so you don't have to. It's just wise planning.
Now, this is why at the beginning, when we started this chatting interview, whatever you call it, it's tragic that less than 10, well, just about 10% have more than one property. And the realtors don't talk to when they try to list a property or sell a property and explain the benefits of real estate. They just want to make a sale. And this is why we're training. This is the purpose of this interview, that perhaps they learn something.
Yeah, I mean, I hope so. And I got to tell you, your life is going to be a lot easier when you have multiple properties that are paying you income. I mean, that's just what it's all about. I mean, I don't want to depend on the government to take care of me. And
Wow.
I don't consider myself wealthy. But, you know, the bottom line is that when I go to retire, hopefully those things are going to take care of us.
Okay, Phil, just one final thought. Now, we talk about the real estate is the best investment. I can show people on paper that real estate outperforms stocks by 3-1. And very few people they're looking at me, what? The stock market in the last 5 years was producing, I don't know, 15%. I'm not talking about crypto, that they went 2,000% up or something, but the regular stock market. But I can show them that real estate is the best thing. So what advice would you give to investors, realtors, CPAs, financial planners, because a lot of the financial planners I know from the fact they don't like real estate as an investment because they don't get any money out of it.
Unfortunately, that's true, Louis. Folks, if your stocks go away and a company's not there anymore, you've lost everything. Real estate doesn't go away. It may go down in value in cycles, but it still produces monthly income every month. And that's the difference between real estate and stocks and bonds and mutual funds. Though I believe in all of them, don't get me wrong.
Right.
There's a place for them. I think the heaviest part of my portfolio, my wife and I are convinced that it has to be real estate because we can control it. The stocks I can't control. We control who's in it. We control how much rent we can charge, within the rent control thing. But the bottom line is that when stocks go away, everything you have goes away. When real estate goes down, you still have the rent and it's going to come back up because there's a constant housing shortage. So it's a great place to put your money. And the federal government gives you this benefit of selling the property, not having to pay between 30 and 45, 50% tax to keep the money and to reinvest it into better properties through a 1031 exchange that will make you more money in income, more money in appreciation, and more money in tax write-offs. What an opportunity. The question is, will your clients want to do that? Well, it's a personal choice, and everybody has to choose what they want to do.
Yeah,
most people. You go ahead. Most people don't plan to fail. They just simply fail to plan.
That's right, but I think the education part comes in very, very heavily because most due respect to there are some excellent realtors, but some of the realtors have absolutely no conception why real estate is the best investment for retirement and so forth, because they don't understand the 5 economic benefits, and this is very, very important to educate the public. If I got, anyway, listen, Phil, it was a real pleasure and I really enjoyed listening to you. You are certainly didn't let me down. You're very, very knowledgeable. I thank you. So I'm going to stop the recording now and just your information and my information will be on the podcast. So if anybody wants to get in touch with you, they can contact you and they have any question. And I hope they're going to do that. Okay.
Thank you, Louis. I'm honored to be here. Thank you for inviting me. And I wish your listeners and watchers all the best.